Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Jeff, let's talk about the other end of the spectrum here. Let's talk about some stocks that you wouldn't buy with my money. I'm generous. Here's some money. Why don't you go buy, I don't know, Robinhood? Are you going to buy Robinhood with my money, Jeff?
Not happening, Jason. Not even with your money. I'll start off, before I get into why I wouldn't buy Robinhood, I'll give them credit for one thing. They created a very user-friendly and attractive way for newer investors to get interested in investing, and
they've introduced investing to millions of people.
Yep. And did that also kind of push the entire industry away from trading fees, right? They
weren't the first, but they were an early disruptor in driving those commissions to zero pretty much across the industry.
Right. So that's all the good stuff. Now, I'm not even going to get into business metrics too much with this, but here's my big issue. Their entire business model is built around payment for order flow, which we're not going to get into in detail, but essentially what it means is they are incentivized, they need to incentivize trading in order to make money. So their app, while as appealing as it is gamified, right? It makes you want to open it, check your portfolio all day long, buy things, sell things, buy things, sell things. And as someone who truly believes the real way to invest is to do it over the long term and not to be in and out of positions, I think that their business model is based around incentivizing the wrong type of behavior. Not only that, it's also it's a cyclical business model, right? So during 2020, 2021, when the stock market was going up and everything was to the moon and rocket emojis on Twitter, they did great. They had people were buying and trading crypto, stocks, everything. They had fantastic financial results. But fast forward to the last year or so, completely opposite, right? People are
here's their Q2 results, right? They're looking at year over year, or even quarter over quarter more accounts, but then like things like active users, almost 2 million fewer active users in the second quarter versus the first quarter. The collapse in market values, 31% reduction in assets under custody. And that's exactly what you're talking about, Jeff. That's the nature of their business, is so focused on making money from the large hedge funds and other folks behind the scenes that buy the trading flow so they can make just a little bit of arbitrage and a little bit of money on every transaction. So it's kind of the hidden commission that's there, right?
Right. Yeah. So from a standpoint of I want my portfolio to reflect my best vision for the future, and from just a straight up business model standpoint, I wouldn't buy Robinhood even with your money.
All right. Well, I've got one that if you were generous and were to give me some money, I would not use your money to buy, Jeff. And this is one that's already in my portfolio. It's a stock that I actually already own. And I've talked about on another video, and that's Peloton, ticker PTON. So why is Peloton on my won't buy it with anybody else's money list right now? And it's simply that the company has so much to prove in the way that its business stands right now. You look at the stock, it's trading for around $10 a share. It's down more than 90% from the all-time high. It's probably still bumping on all-time lows right now. We're recording this on August 26th. The market's still open. It's probably going to close at an all-time low. And what's happening? The thing that's happening is, as much as the company is looking at metrics and saying, hey, we're cutting our cash burn, we're tightening our belt, and all those things are positive, we're downsizing, all of those things make sense. The company has to, really. It's doing those things. And they're saying, well, you look at our metrics this quarter versus back before the pandemic, hey, we're looking pretty good. But when they start doing that, like they're looking at like their engagement, monthly average workouts, which is a pretty important metric, because the core thesis for this business is getting people to have a bike and then pay for that monthly subscription and use that and stay engaged and keep paying that monthly subscription. That's where the company is going to make money. They said in the second quarter, they had just under 15 million average monthly workouts per subscription. It was down from the quarter before, but they said, hey, we're up from 2019. You're pretending like all of those bikes that you sold and all of those subscriptions you sold over the past couple of years didn't exist. You can't do that, right? That means that people are disengaging. That's a major thesis breaker for this business. So until they prove that this is just a temporary headwind, this is not a good time to be buying Peloton stock.